Good afternoon, UK. This is Tim and Chris on the buzz as per usual. Now, we have missed a week, but we're back for talking about anything to do with your money, anything to do with your financial education, giving you that buzz and keeping you updated on everything finance, business, and tech on the on Relax Radio. We have Chris today. So, Chris, what are we talking about today? Good afternoon.
Hey, Tim. Intergenerational wealth, right? That's what we're talking about today. How do you get rich? Well, generally, if you're born rich, it helps. So, how can we help our kids get rich and our grandchildren get richer from it? And it takes some planning. Otherwise, you get taxed literally to death.
Planning and discipline.
Well, this is about more planning, but yeah. So we'll get into how you can mitigate estate duty taxes, what the limits are, what do you need to think about as well.
Yeah. So when we're talking about today's conversation, we're going out in the lines of estate planning, and then how do you break it down? What do you really mean by that now? Generally, it might break down into real estate, but then how would you, a financial analyst, being in the industry for over 2 decades, but how would you say you have to look at it?
So when you die, your estate gets added up, right? Everything in your name, and it comes to a figure. Depending on that figure, you get your beneficiaries or your estate gets a tax bill. Okay, so we can mitigate that tax bill. That's called the estate planning, and it's called in this country inheritance tax. The limits here are £325,000 per person. So if your estate exceeds that amount, anything above that, you will incur 40% tax, which is quite high, right? And if you think of, you just think of property prices and those kind of things. It's not so difficult to go above that limit. It was changed recently, as recently as 2016, that spouses, so if you legally married in a civil partnership or a marriage, you can use your spouse's IHT limit as well. So you could effectively, on the death of the first person in a marriage or a civil partnership, can utilize £650,000 of null rate band. However, when your second spouse dies, then there's no room, right? So whatever they die with will be taxed as well. And a lot of people think, well, I'm not wealthy enough to actually think around this. However, with inflation, things costing more, especially houses and property, people tend to fall in this gap. And we can, there's various strategies to help people alleviate this burden, from simple as life cover through to trusts, and we'll cover some of those now for you. So if a person is looking to leave money to their children, which hopefully there's quite a few people out there that do, and they've got some extra money and they're saving and they've worked their whole life and they've got investments, and as you say, they may have multiple homes bringing in buy-to-lets, and they haven't thought about this before. So they haven't structured anything up front to mitigate any of these taxes. Then we can still help them. We can still help them quite a lot. The easiest route is to say, okay, let's take a snapshot of your estate and see what the potential liability is. Okay, there's if you're over 325,000 and you're not using your spouses, there's a liability. And let's say you've got £1 million in the bank, right? So for argument's sake, your liability is £675,000. That's going to be chargeable to IHT. So I don't know my calculator with me, but it's about £300,000 of tax that you could pay. So we can say, okay, instead of your beneficiaries paying that tax, let's take out a life cover on your life for that amount, which is fairly low cost because it's going to cost 10 quid a month or something to that effect. And then when you die and you pass those monies on, the tax gets paid with the life cover, so that your beneficiaries get the full amount and the full benefit of it. But then we fall into another problem, and this is why I talk about intergenerational wealth. We fall into another problem where your kids, as an example, who have benefited from your estate, have received those monies. Let's say they are good custodians of those monies that you bequeathed them, so they grow it and they have more wealth when they die. Now they've got the same problem. They've got an IHT problem. They've got to have a financial plan, and so And if someone doesn't do it along the line, then it falls over. So we talk about intergenerational wealth and what can we do to help people say, okay, not only securing my kids' future, but their kids and their kids and their kids and their kids, so that they get leg up in life through not having to have student loans, or they can get a car or a deposit house, things like that. And for that, then we go one step further and we start to use things like trusts, where trusts not to hide assets from family members or the government, HMRC, but what we do is we use the trust to gift assets through to our beneficiaries or our families. And then the money stays in that trust under the custodians of professional trustees usually. And those professional trustees engage people like me, it's financial planners, to help manage the assets in that trust and facilitate ongoing management for those families. Yeah, I mean, so I'm just carrying on rambling here to make sure that so just interrupt me when you want to. The basis of a trust does sound quite complicated, but it doesn't have to be. Yes, there's varying trusts, and yes, they can get as complex as you like. However, the basis of it is a discretionary trust, meaning the trustees or the custodians of those assets have discretion to pay out those assets to other people. Yes, the person setting up the trust has a say, and they put in what's called a letter of wishes, which describes what happens to those monies on their death. Yeah. And that should match your will.
How often do you come across, how often do you come across a case where you need to do the whole trust transfer or evaluation in your office? Let's say if it's on an annual basis.
Oh, we do it all the time.
Is it quite often, or?
It's quite often. Most of my clients are entrepreneurs. So, as an example, they have acquired their wealth through the sale of their business, which allows us, just skipping ahead a bit, allows us additional planning opportunities.
Yeah.
In the UK, we have something called business relief, which allows us, if there's, and it's got to be within qualifying assets, and it's a specialist area, but we can set up a business relief trust and invest in business relief assets so that that client really has the advantages of not only mitigating the full tax on the sale or the proceeds of their business because they qualify for business relief. However, the intergenerational process of that trust within a business relief process is massive. And that's the main ones we do, is for people selling their businesses. If you didn't sell a business, that's okay. We will still set up a discretionary trust and we still manage it in the same way. However, the taxes within that trust will be slightly larger, but in no way near the 40% that would be due on any assets above the £325,000 within the current climate. And these of course can change, these climates, and they possibly will change. I think government,
when it comes to the so it
Sorry, Tim, you're saying? Okay, then we lost Tim quickly. What we'll look at is the process that a person goes through to set things up if we identify that there is an issue with inheritance tax. Because often there's also what's called the resident nil rate band, which is in addition to the IHT nil rate band, and that's on houses. You've got to qualify for that. Are you back, Tim?
Yeah, I'm here.
What was your question? Sorry.
So in terms of, evaluating, or, in terms of approaching you, what type of questions would what type of questions would you ask, your customers or your clients, and then how would you say they have to approach a whole transfer situation where they have to get the whole evaluations done? What do they have to get ready before they approach you? How would you say an ideal, a successful transfer would go?
Well, look, I mean, the first thing we do with any client is we look at a snapshot of their assets and liabilities, right? So we kind of get a picture of their net worth and what income they have and all the sources of income, and then where all those assets and or liabilities are sitting, whether in the UK or outside the UK. And that kind of accounting snapshot